Good morning. Welcome this morning to Trading Futures. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm glad to have you here. We're talking about trading futures this morning. And out there in the chat, I've got my good friend Michael Fairborn. He's been covering this class for me for the last couple of weeks as I've been out on the road, and I'm going to be out on the road again coming up this weekend. So I'm going to talk about that as we get into this discussion today. But we've got some stuff moving already this morning, including some of the currency futures. So we're going to take a look at that really quickly here. Welcome to all of you that are joining us in the live version. Welcome to those of you who are joining us in the recorded version as well. Michael Fairborn's out there to help answer your questions in the chat. A couple of quick reminders as we get started. Just from a housekeeping perspective, remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you are aware of those risks. Read the risk disclosure statement for futures and options prior to considering any futures transaction. Remember that futures trading requires separate trading authorization. Futures accounts are not protected by the SIPC. So make sure also that you understand the differences between initiating an equity position and initiating a futures position regarding margin requirements. We'll talk a little bit about that as we get into this discussion this morning, but there's lots of different ways to look at the market. Also, fundamental analysis, technical analysis, probability analysis. None of those are guarantees. We're going to use some technical analysis here this morning. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Now, we're going to be using the thinkorswim desktop software platform, specifically the paper money version of that platform. It's a great learning environment. However, it does not facilitate the early assignment of options. So it doesn't also do certain things as far as studies and scans. So be aware of those changes and differences as you move from one platform to the other, from live trading and paper money trading. So additionally, one of the things that I want to point out this morning is that stop orders, protective orders on futures contracts are a little bit different. They work as when you initiate a stop market order. That market order becomes an exchange designated limit order that's worked within a protection range or at a protection point. So there is a very real possibility that a stop order on a futures contract that is worked as an exchange designated limit order may not get filled, especially in a fast moving market. Stop limit orders are issued as a limit order. Again, there's the possibility that those orders, especially in a fast-moving market, could be gapped around. So we'll talk about that as we get into this discussion for today. But just a quick agenda. We're going to talk about futures contract asset classes. We're going to talk about futures, probably not talking about futures options this morning. We're going to look at some examples because there's one I want to get to really quickly here. And what I'm going to do is I'm going to pop over to the thinkorswim desktop software platform. And that's where we are right now. We're going to put this trade on really quickly because it's starting to move. So I want to get this trade in, this example in to illustrate what's going on. But here's what we've got going on. This is /6J, which is the Japanese yen currency futures. And you can see what it's been doing. Over here on the left-hand side, I have the 1-year daily chart. So you can see that kind of move up, move back down. It's made kind of this W pattern or double bottom type pattern, and then again another little bit of perhaps a bit of a cup and handle type of pattern. Now making perhaps that handle portion of the pattern over on the right hand side. That's the longer term view. On the right hand side of the grid, I have our today's 5-minute chart. So each one of these candles represents 5 minutes of trading time. It's been moving really in the last little bit. It's especially been moving very quickly over the course of the last couple of hours, and over the last 10 or 15 minutes or so, we've seen this pull back into the support level, which was kind of the apex of this double bottom pattern, and then it's been rallying higher. So I'm looking now at this particular point for a breakout of this level right here, the 70.00707 level, as a breakout potentially to the upside. Notice that that also corresponds kind of with this resistance level back on the left-hand side. Good idea to look left to confirm what you're seeing right. So I'm looking for a breakout here, and I'm looking for a move intraday. So in the shorter term in this particular case, simply because of that bullish momentum that's built, the stronger CCI, it's starting to see some upward momentum. Looking for a move out to the 0.0072 target in this particular case. In order to get there, it's got to get out beyond 0.0071, but 0.0072 would take it back up to a previous level of resistance. So now we're getting the breakout. So let's put this trade together in this particular case. And we're going to look at taking this trade off if it goes the opposite direction down to this 0.007063. So that's going to be the other side of our trade as a stop limit order or a stop market, and then expected it's going to be worked by the exchange. So I'm going to right click. And again, this is not a recommendation. This is simply an illustrative example. But what I'm going to do is I'm going to create an order. And we're going to do a buy custom with OCO bracket. And this should answer the question for those of you that say that we can't do OCO brackets on futures trades. But here's what we're going to do. We've already kind of got our lines in place here to specify the order. So we're going to look at getting in on this breakout. It's kind of making that breakout right now. Now, we could, if it weren't up above that level, and I'm likely to see this 5-minute candle close there at the moment, but we could put that in as a buy stop order. Now remember, a buy stop order becomes a buy stop triggered by that order, then it becomes a market order. But we're going to make this a limit order, so we're just going to get into the trade. So even a buy stop order that triggers a market order is going to be worked as an exchange designated limit order, just because of the nature, and that's an exchange rule and not necessarily a broker rule. That's from the exchange to prevent fills that are way outside the market, especially in a fast-moving market. So what I'm going to do, I'm going to kind of shrink this over a little bit so that we can see what our prices are here in this particular case. And so we're going to look at taking the trade off at 0.0072. Okay, so we're going to change our limit order to exit this position to 0.0072. That's going to be our exit on the upside if this makes that move in the direction that we're expecting it to go. So this is going to be, now, C asked the question, would this be Forex trading? No, this is not. This is trading the spot futures market, or the futures market, which is an expectation, right? The currency market, to a certain extent, is pricing one currency in another currency, right? So yen priced in dollars. That would be an example of the Forex market trading that spot price and that spot relationship. This is the futures contract, right? So this is the future expectation of this currency. But the underlying basic movement here comes from the movement of the spot price on the currency itself. So that's going to be our order to take this trade off. I'm actually going to open up my limit order here, and then I'm going to readjust. I'm going to open up that lock, and then I'm going to readjust my exit order here to 0.0072 once again. So I'm going to kind of capture this move. And while I've been talking, as this always happens, I talk through these orders. So we're going to get out if this goes below 0.00706. So I'm going to come back down here. We're going to make this our market order, and we're going to say below 0.00706 is where we drew that line to the downside. That's going to be right here if it breaks down below 0.00706, right? Double check our numbers here, make sure that that's what we want. And I'm going to make these good till canceled simply because there is the possibility that this could continue to kind of move sideways or not move down. We're going to likely have this trade on and off relatively quickly. Now, this is a big contract, right? So when we click on confirm and send, we're going to see the margin impact. That initial entry margin into this trade is about $4,100, right? So if we take a look at the specifications of the contract, which we'll do. Let's put the order on, then we'll come back and take a look at the specifications of the contract. But I'm going to read through this order. It's always a good idea to read twice and then trade once instead of reading once, trading, and then trying to trade out of something that you didn't intend to do. So we're going to buy one contract of the 6J /6J yen futures contract, getting into the trade here at a limit of 0.007076, getting out if it goes to 0.0072, and getting out if it goes against us 0.00706. We're going to put this in our futures account group in our monitor tab. We're going to go ahead and click on send, and we're going to send the order off. And we got filled where the price is now because it pulled back just a little bit, but it's broken our threshold for getting into this particular trade. So it's, yeah, and you're right, it is already above kind of that pivot point here. So we're looking for this to make that move. If I were going to stretch this down a little bit here, we're looking for this to make the move up to basically through this line. And I'm going to just keep squishing up to here. So just let me annotate this really quickly. We'll kind of talk through this. So we're looking for this move to go up to here. Breaking this level was our threshold. Breaking this side is our downside exit. So if this moves against us, we're going to take that trade off pretty quickly. But if this moves in the favor of the direction that we want it to move, which would be to the upside here, which is indicated by that upward movement in the MACD and the CCI moving in an upward direction as well, both of those giving us that kind of bullish pressure to the upside and seeing that move up towards that previous target. We're in the trade. This may not be just a single kind of day trade, intraday trade, not day trade necessarily, but intraday trade. It may take a while for this to move, although this is a contract that can and does, and we've seen move relatively quickly in the short term. So let's go ahead and kill those annotations. We'll kind of come back here and we'll talk through this again. So I want to talk through kind of the specifications of this particular contract really fast. By the way, let me take a moment now that we're into this example, and it's starting to move back against us, but that's not a problem because sometimes that can happen. But I wanted to just say thank you to all of those who joined us for our advanced options and intro to futures workshop in Dallas this past weekend. I know a number of you were there. George, Dragon Rider, David was there. Ricebird was there. So I appreciate you all being there. We spent a little bit of time. Actually, we spent one section of the webcast talking about futures contracts and kind of getting into the initial discussion of introducing futures contracts. So what I want to do is I want to come over here to the right hand, or excuse me, the left hand side. I'm going to make that a little bit bigger in my grid here. And you can kind of see the movement. Now, is there the possibility of further upward movement in the 6J? Sure. Is there the possibility that it fails at this resistance level? Sure. But you can kind of see that technical analysis pattern that's working itself into here, this kind of big cup and handle. But let's talk about the contract itself, right? So tick size is 0.000005. So you can kind of see how that lines out here. So what that means is that the smallest increment that this number, let me line this number out here. So that the smallest increment that this number moves is by the amount of this tick size, right? So you're not going to see in this far right hand digit place, you're not going to see a 1. You're going to see either a 5 or a 0 because this moves in multiples of 5, right? That's simply because that's the smallest tick size. So every time that tick moves one way or the other, when we get that move from 705 to 710, that's a $6.25 move per every tick, okay? So what that means is if we were to see a point value move, And that point value move, in this case, let me clear these annotations really quickly. That point value move would be this moving from 1.00 to 2.00. That point value move would be $12,500,000. That's that point value move. So if this were to go from 1 to 2, that would be a $12 million move, or $12,500,000 move. But our notional value of the contract is simply this: $88,387. Okay, so where do we get that number, right? So 88,393 is simply this, which is this number times this number, right? So that's a times value. So that number times that value gets us our notional value. Okay? And I've shared this label before, but I'll do it again. That chart label is a custom script. By the way, if you want to learn a little bit more about scripting, Michael Fairborn teaches a great class on Friday afternoons on Think Scripting. You can build labels like this yourself. You can build custom indicators. You can build custom watch list columns, all kinds of great stuff. But I'll come back up here and let's do this. I'll also put this is already in the description for the webcast, but I'm going to go to my icon here and we'll go to our futures labels that I've created. Here it is. I'm going to go ahead and share this as a ThinkScript study, and we'll go ahead and we'll put this in the chat. Okay, Control V. And remember that anytime we share anything, any shared items are not guaranteed as to time or accuracy. So there you go. There's that ThinkScript script that puts those future labels on the chart. Now, there have been some circumstances where traders have not been able to use bracket orders in futures trading. Here's one of the challenges, and it's not necessarily not working. It's one of the challenges that is presented by putting bracket orders on a futures trade. So let's go back over here and let's kind of restore ourselves. Let's look at this right-hand side. So I'm going to expand this right-hand side for just a second. So here's our thing. We've got an exit down here, and I can show these orders on the chart. So we'll click on apply and OK. Now there's our order. So here's our exit order up here, and here's our stop order down here. The challenge in having a bracket order, especially in a fast-moving futures market, and especially if those bracket orders are close together, is that you could run into the possibility where both sides could get filled, simply because you run into that scenario. Did I do that right? The South Carolina? No. Okay, hang on. Let me come back and do that again here in just a second. We'll do that calculation. But you could run into the situation where the market moves quickly and comes down and takes out or triggers that sell order to the downside, and then quickly comes back and moves towards your order on the top side. And if those orders are close together, those could get into a situation where, and probably not in this because these are further apart, but in some cases, if they were close together, you could get triggered and filled on both sides simply because of that fact that they got triggered. The market is filling on one side, and not before the opportunity comes to cancel the other side of the bracket order, the market slams back the other direction and triggers and maybe fills that order on the top side or on the opposite side that just got filled. That is a possibility. It's a remote possibility, but it is a possibility. So it's something you got to pay attention to, especially in fast moving markets where those bracket orders are close together. We're not close together here in this particular case. Not close enough that that's likely to be a scenario, but it's always something that we want to pay attention to and be aware of the risks. Here's one of those things. You got to think about futures trading from the perspective, and there's a reason why in those disclosures, the beginning of this discussion, and the beginning of any time we talk about futures, and really the beginning we talk about any time we begin talking about anything, whether it's options, whether it's stocks, we express what those risks are, because there is the possibility that those circumstances could occur. So be aware of that fact, right? So, Cole asks the question, do we have to worry about these resistance levels? Yeah, I mean, those are certainly levels. They're not guarantees, but those are certainly levels that we want to pay attention to. And this trade's starting to go against this, but we'll see if potentially it bounces up off of this level of support just above where we placed our exit order. So we're going to look for that bullish movement here as part of this kind of maybe bull flag now, or breakout of this kind of double bottom reversal moving to the upside, looking for a bounce and a move back to the upside. Now, that being said, let's come back and let's look at that notional value, and let's just do the math really quick. So let me clear my annotations there. We'll go back here. We will go back to restoring our cells. We'll go over to the left-hand side. And by the way, this grid that has the two sides in it is also in the webcast description. So let's do this. Let's bring our calculator on over from the left-hand side, and let's take 88,340. Whoops, 88,000. What is it? 88,337.50. 88,337.50 divided by 6.25 is, oops, sorry, 88,320, what are we now? 320, 335, 337. 88,337. And we're going to get to so 88,337 times 6.25, okay, that should be our tick value. Am I doing that math right? It's an early morning, guys. I'm going to have Michael help me with that. Yes. Okay. All right, let's do this. Here's what I'm going to do. I'm going to pop back over here to my grid. Whoops, I didn't want to take a screenshot of that. I want to restore my cells here. There we go, restore cells. Now, let's change this grid back to our futures grid. Let's see what's going on here with equity futures this morning. And let's take a look at what's going on. So here's the Russell 2000. We've looked at the small caps before. We've traded the small caps before as an example trade. But once again, kind of making this V-bottom, almost V-bottom type of reversal, rally up, a little bit of a bull flag, and running into a resistance. And this is very similar to in terms. Yes, it is. Thank you, Carol, for understanding this. So this morning, the equity futures contracts, the Russell, the NASDAQ, the S&P 500, all kind of running into this kind of resistance level that we saw back here into the March and April timeframe. And running into this resistance right about the 2000 mark. Breaking up above that point could be a longer-term bullish indication. Breaking up above the 50-period moving average, also that indication. The S&P 500 kind of already running right up into, if we were to take this line here, I'm going to remove that drawing, and I'm just going to draw a new level of resistance here, kind of right around this range. The S&P 500 today is positive in the futures, but it's kind of hovering right about this resistance level. We're kind of sitting at this 55.49, 59.50 in this particular case, and looking for that move to the upside. The NASDAQ futures a little bit higher than where that resistance level is. Perhaps it's already made that breakout. I'm going to remove that line. We're going to put this level of support in right about here. I'm looking for that break to the upside, maybe that break, but we've got positive bullish movement in the RSI, so kind of a positive rate of change, if you will, to the upside here. A little bit of a sideways movement today. Now, a lot of data, economic data from an earnings perspective is coming out this week, as also we're likely to see some futures market movement from the non-farm payroll report at the end of the week. Here we are Tuesday, so there's a lot of market left between now and then, and starting to see that upward push here in these equity markets. Now, one thing that I wanted to take a look at, I'm going to go back over here to our monitor tab, and this is a trade and an example that we did in the Dallas Advanced Options Workshop, but I wanted to talk through this again really quickly here. I'm going to do one thing really quick before I do that, and I'm going to move this back to my temp group. So what I have right now is I have a portfolio of equity positions, and this is talking a little bit about one of the uses for the futures market when you are not necessarily a speculator on futures movement. This is using futures contracts as a means to hedge a portfolio of long stock positions. So in this particular case, I've got a fair amount of stocks in this particular portfolio, and they're kind of broad cross-section. I've got some financials, I've got consumer discretionary or communication services, if you will, industrials, but also consumer discretionary, right? Delta Airlines. We've got agriculture. Calm is Cal-Maine, and that's eggs. We've got AbbVie in the pharma space. We've got Joby in the technology space. We've got Coca-Cola in the defensives. We've got consumer discretionary in Ross Stores and TJ Maxx. We've got a financial stock in here. So we've got kind of a broad cross-section of stocks. We don't have a lot of materials. We don't have any energy here in this particular portfolio. So we're going to use something to perhaps beta weight this portfolio to kind of perhaps offset that possibility of downside movement. But remember, whenever we hedge any position, you've got to remember that the purpose of the hedge is to protect against adverse movement. The purpose of the hedge is not to be its own individual speculative trade. And all too often, I think that's what happens with hedging, and a lot of traders is they start to focus on the profitability of the hedge and forgetting the reason that it's there, right? Forgetting the purpose that the hedging position is there, right? So as Wiley pointed out, 1,100 deltas. That's a lot of deltas, but what does that really mean, right? Here's that 1,100 deltas, right? So what I've done is I've put on this chart, by using the gear icon, a column titled Delta. And that Delta column represents the coefficient of movement, right? The delta, if you will, the sensitivity of option, or of the price movement to the movement of the underlying stock. Well, these are all the underlying stocks, right? So if AbbVie goes up $1 and we have 100 shares, this position gains $100. And if AbbVie goes down $1 and we have 100 shares, we lose $100. So collectively, when each one of these positions moves up or down, that's the sensitivity. But that's the sensitivity of the collective of these. And George, I'm getting to that. The collective of each one of these individually, right? So this doesn't tell us anything necessarily, other than what we already know by knowing that we've got 100 shares of the stock. So this delta of 1,100 is neither high nor low. It's simply the collective aggregation of the total number of individual deltas of the positions in the portfolio. So what does that do for us? Well, right now, not much. But what we can do with this is we can come up here to this beta weighting component, right? So I'm going to click on beta weighting, and we're going to beta weight this to something. Now, this is kind of a broad cross section. We're going to beta weight this to the S&P 500, which is also a broad cross section, but we're not going to use the big S&P 500 contract. We're going to use /MES, which is the micro E-mini. It's 1/10 the size of the big contract. Let's go over here to the charts really quickly, and let's take a look at, I'm going to change my grid here to my single grid, okay, so that we can see this. And here's the MES, right? So here's the MES. This is the micro E-mini futures. We were familiar because we looked at it just a minute ago with /ES, right? So that's the big contract. You can see the notional value of this contract is $277,212, right? 25-cent tick size, tick value is $12.50. Point value is $50, okay? So if we were to go to the /MES, by the way, you can find all of these if you click on the drop down and you go to the futures sub-tab, and you can see those micro futures that are here. We've got a micro gold, which we've looked at examples before. We've got micro copper, micro emerging markets. We've got micro 6A, 6B, 6E. We don't have a micro 6J, which is why we traded the big contract on the yen this morning. But we do have this /MES, right there, the micro E-mini. And you notice that if we switch to that one, to the /MES, that tick size is 0.25. The tick value, instead of being $12.50, is now $1.25, and the point value goes from $50 to $5. And so this is 1/10 the size of that big contract. So what we're going to do is go back to our monitor tab, and we're going to take a look at this portfolio. Now what we've done is we've converted everything in this portfolio to a common delta coefficient. So using /MES and using the beta number, now we could even put beta in this particular column, right? So we can put beta in this column, and let's move that up a little bit to next to our delta and click on OK. So now you can see what that relative beta is for each of these positions relative to the MES, okay? And now we can see that when we calculate this beta coefficient, so what this says is that AbbVie moves, in this case, a little bit faster than the MES. AWR moves actually inverse to the MES. CalMain moves a little bit faster. Delta Airlines moves just about the same as the MES. Disney moves a little bit faster than the MES. HIMS moves a little bit faster than the MES. Joby moves a bit slower. Coca-Cola, or actually JP Morgan, moves a lot faster than the MES. Coca-Cola moves a lot slower than the MES. Ross Stores just about the same as the MES, and TJ Maxx a little bit slower than the MES, right? So I wanted to kind of relate that to that level of movement. What that says is right now this portfolio is sensitive to MES /MES deltas to the tune of about 14.87 deltas, about 15 deltas, which means that if MES moves up a point, our portfolio should move up about 14 points, 15 points. It's theoretical, so don't get caught wrapped up in that, in the precision calculation, right? Because it's not going to be there. This is a theoretical relationship. So it's always dynamic as well. So as this moves, all of these numbers are moving as well. But what we can do is, if we were looking at that chart and we're saying, look, there's the potential for this to move to the downside, right? To kind of see adverse movement, we could take advantage of that potential for downside movement. We could sell a futures contract, which would increase in value because we're short that contract, right? That position, being short the contract, would increase value the more that MES went down. So by shorting that contract, we're adding to this position negative deltas. We're taking some of that sensitivity out. So here's our position. We are short one contract of the MES. We shorted it at 5552.75. It's now currently trading at 55.56 or 57. So right now it's gone up a little bit, but we're still short. So that's going to add negative deltas. So what I'm going to do is I'm going to go move to group, and we're going to put that in that particular group. And you can see that that's taken about 5 deltas, because remember, we go back to that chart. What's each point value worth? $5. Okay, so that's where we get that 5 deltas. Now we go back to the monitor tab. We've reduced 5 deltas out of the equation. If we wanted to reduce this a little bit more, make this less directionally sensitive, because it's still directionally sensitive, we could add another short put contract to this position. So let's do that. Let's go to the trade tab for /MES. And what we're going to do is I'm just going to simply click on the bid price, and we're going to add another short contract to this. That's going to add another 5 negative deltas to this position. I'm going to click on confirm and send. We're going to put that in the stocks group, and we're going to send this order off, and we'll see if that order will fill. And what we've done, and what we will do once the order fills, is now we've reduced our portfolio sensitivity by 10 deltas. We've made this almost market neutral. Now, if the market starts to rally, that's going to be a drag, and we want to pay attention to the fact that that's dragging on our portfolio, right? So if MES starts to break down, or excuse me, starts to break out, that's going to be working, that negative 10 deltas is going to be dragging on our portfolio and limiting that potential upside gain. So what we could then at that particular point do, if this breaks out, is take these 2 contracts off, or take one of them off and let it move a little bit more. So what I'm going to do is I'm going to move those to the temp group, and that would be taking both of those contracts off. And now we're back to being more directionally sensitive. So these futures contracts can be used to manage the sensitivity of a portfolio. That's the idea behind portfolio hedging using futures, and it's another way that futures contracts can be used. But you got to pay attention to what the cost is, right? In terms of entering that trade, let's go back to the trade tab, and let's look at entering another position. This doesn't matter if we're long or short. We're going to have to have that initial margin and then maintenance margin in our portfolio. So if we go ahead and click on the bid price here, again, like we did, if we were going to initiate another, if we wanted to make ourselves totally delta neutral in this particular case, we could go short another, click on confirm and send, and I'm going to move that to the temp group right now. But you see what that initial buying power effect is? That's the initial margin for putting this contract on. And then this is going to be marked to market every night, and then that's going to help to determine the value of the position, and that's going to also be a function of that maintenance margin, because maintenance margin, the amount that's then required to be kept in the portfolio in cash to satisfy that maintenance margin, that's going to be less than the initial margin of the position. So if we click on send and we fire that order off, now we've filled that order, and now we're short, or now we are short. Now it's filled. Now we're short 3 contracts of the MES. If we go move to group and we move that to the stocks group, now notice that we're essentially, for all intents and purposes, delta neutral. So for a day like today, where the market's kind of moving sideways, as we looked at that chart, it's kind of going sideways. Delta neutral, probably not the worst place to be, but if this starts to move, now a trader may start to peel off some of those short contracts if this starts to move to the upside, and allowing the portfolio to be a little bit more bullishly sensitive. If it starts to move to the downside, that big hedge, because we've got 3 contracts of the MES here, that big hedge is going to offset that downside movement, because those contracts are going to become more valuable as that price moves to the downside. But at the same time, we've now tipped this portfolio to leaning directionally to the downside as opposed to being a bullish stock portfolio. So you got to keep in mind, what was the purpose for the hedge in this particular case? And the purpose for the hedge was to offset potentially downside movement. If it starts to go bullish, that's an important consideration. Attention must be paid here in this particular case as you do this, to watch for that. Yeah, /MES is also 5 delta, right? So let's just do this really quickly. For example, as we're wrapping this up, I'm going to take these out. I'm going to go to the /MES position. I'm going to move that back to my temp group. The reason I have that temp group is so that they can move these in and out of that stock portfolio so that you can see the impact. If we were to go now in this particular case to the chart and we were to change this to /ES, the big contract, right? 10 times the size of that /ES. That's 50, right? So that point value is $50. So watch this. If we were to go to the trade tab and we were to initiate, so let's link this up /ES, /ES, and we were to use a short position on the big contract. So we click on that bid to initiate a short position in this big contract. We click on confirm and send. Look at what our margin requirement is. Our margin requirement in this case is 22,146. So now, if we were to put this on, I've got enough buying power in this particular account to be able to do this. So what I'm going to do is I'm going to put this in my stocks group as an illustration. This is an illustrative and educational example. And I'm going to click on send, and I'm going to fire that order off. And we'll see if that order fills. And if that order fills, then you'll see the delta impact to this portfolio. Remember, we're short. Now, look, here's the thing. We're short we are sensitive 14 MES deltas. That's because we are still beta weighted to /MES. I'm going to show you what happens when you have a disparity between the position that you're filling and the contract that you're using. So I'm going to go ahead and I'm going to cancel or replace this. I'm going to open that up and let's see if we can get that position to put on. Click. We'll see if we can send that order off and get that to fill for us. And it might not in this particular case. That's starting to move a little bit. We'll see if that order fills. But if we were to fill this, and I can adjust this because it's paper money. So there it goes, now it filled. So now we're short 50 MES deltas. So you notice that now we're way overhedged. So if we change our portfolio beta weighting to /ES to match our position, right? Now we're changing our portfolio hedge. Let's take that off and then put that back on. So we're still way overhedged, right? We're still, because these are going to be the same delta weightings because this is the same instrument, we are still way overhedged, which means that we're now leaning substantially bearishly. So beta weighting with the big contract puts on more of a hedge than we need to put on unless we wanted to shift our portfolio to being bearish, which we don't necessarily want to do. So I'm going to go ahead and I'm going to close this position. I'm going to just buy it back and eliminate that. And we're going to click on send and flatten that position. And that'll take that big ES hedge off. And then we know that we've got our 3 contracts. If we move those back to our group stocks, and let's move this one out until that fills to temp. Now we're about delta neutral at this particular point. So that gives you an idea of portfolio hedging and using futures contracts to be able to do that. If you want to learn more about this, come on over here to the Trader Talks webcast page and type in the word futures or even beta weighting. And you're going to see a bunch of, there's Brent Morris talking about it right there. Beta weighting, portfolio risk, and hedging. Beta weighting, beta in your portfolio. You can see Brent talks about that a lot. I talk a lot about that a lot. Michael Fairborn talks about it. Cameron talks about it. So you're going to see a lot of great information about portfolio beta weighting. By the way, if you want to join us for live events, you can find out right here on schwab.com/coaching. Go to our in-person events. We're going to be in Denver coming up this weekend, guys. We'd love to have you there. join us. You can click right here if you're in the area, if you can travel to the area. There's how you register for that particular event. My thanks to Michael Fairborn for helping us out today and bringing some great participation to the chat. My thanks to all of you. Remember to click on subscribe and like. Also, remember to follow us on X at Ben Watson CS, at Mike Fairborn CS. Guys, thanks very much for joining us. Thanks to our great production team for helping out as well. And we will see you again next Tuesday in this webcast. Take care, everybody. Bye-bye.